No, sir, no, sir.
So, hello, sir. Saurav here from Titan. Mr. Arun, can you hear me?
Yeah, I can hear you.
Yes, sir. So, we have 1 more minute. I think we'll just give our participants, 3 more minutes time because a few are yet to join.
Yeah, sure. No worries, no worries.
So, at around 3, I'll start.
Sure, no problem, no problem.
A very good afternoon to all of you. So it's my pleasure in welcoming you all today. And today we have with us Mr. Arun Raghavan to talk to us on the topic VC funding, what founders needs to know. So before we start, I would like to introduce the speaker for today. Mr. Arun is the founding partner at Arali Ventures, a deep tech, enterprise tech focused seed fund. He's also a charter member at TRI Chennai. He's an advisor to various early stage startups on capital raising and performance enhancement. He has an 18-year professional experience spanning business consulting, IT, sustainability, and impact sectors. He's the co-founder of Reimagined, a sustainability-focused upscaling brand. He has various experience in setting up and scaling impact-driven businesses, consultative and solution selling, business consulting, and product design. He specializes in business strategy, new business planning and implementation, operations management, business development, scaling impact businesses. So without further ado, now I would request Mr. Arun to take over the session.
Hello, can you hear me?
Yes, sir. Well and clear.
Yeah. Thanks, Saurav. That was kind of you to introduce me with so glowingly. I hope I live up to some of it. Quickly, I've been asked by when we having a chat with Akhila, we quickly talking about what is involved in fundraise, and given that in the last 3-4 years of actually advising startups and now running an angel fund for the past a seed fund for the past 2 years, what I realize is that there's not a great understanding of what venture capital is about, right? And therefore that basically goes back and influences promoters and gives them, they're not very clear in their heads in terms of whether they should raise venture capital or not. So when we were talking about doing a special a session for founders, promoters on capital raising, I thought you should actually broaden the gamut and basically just talk about what is venture capital first, and talk about why it is the way it is. I mean, just give a flavor of how it works, and then talk about what it means to raise capital, because a lot of times you need to understand what's the underlying instrument you're trying to raise and how it works. Otherwise, it'll have implications on your business. So that's what we're sort of trying to do today. Largely, we'll focus on what is the venture capital, how is it structured, how does it work, right? And then go and talk about what does it take to basically raise venture capital. I'm assuming that a lot of people here in the group are actually entrepreneurs, wannabe entrepreneurs, or actually done this before. So for some of them who probably for people who have done this before, it might be slightly repetitive. But bear with me. I mean, some of it might be slightly more simplistic as well. But bear with me. I mean, I'm just doing this so that I'm hoping that with this there'll be some broader understanding of how venture capital works, and it'll also help entrepreneurs then decide whether it is right for them to go back and raise. So largely that's the context. I have a few slides. I can go back and I'll share my screen and walk you through them. If you have any questions, Saurav, maybe if people can just raise their hand, and then we can try and address it as and when the topic is being discussed, because that make it more interactive. That's okay. And also the way we structured, we also have 15 minutes of question answers time towards the end of the presentation. I'm okay both ways. The only thing is, if you have a question, just raise your hand on Zoom and then we can take it from there. So without much further ado, let me go back and share my screen. Is the screen visible to everyone? I'm assuming it is.
Yes, sir.
Yeah, great. Yeah, so largely, like I said, I'll try and cover uh, cover these specific topics. Talk about what is venture capital. People have various notions, slightly differing notions of it. And in my opinion, what we've realized is it's important for entrepreneurs to exactly understand how it works uh, before deciding whether to go raise capital, right? So we'll try and cover what it is, and also a slightly more deep dive into how it works, right? Uh, and then we talk about some of the reasons why you should actually understand VC. I mean, because obviously there is when you're going to seek a capital and you're going to basically bring people into your company, you need to understand what their motivations are, how they think, so that you are actually aligned and you actually are clear about what they want out of this relationship. So try and cover that. Have a few slides on that, and then try and talk about how do you go about raising capital. This is not meant to be a coaching kind of thing. This is largely meant to be observations of what people do, and also based on experience what typically tends to work better. So largely it's experiential in terms of what we have seen work better and what might make sense for entrepreneurs to do when it comes to raising venture capital. I also have a last section which is there are lots of resources on the net, on the web, on how to do this. I put together a list of some interesting reading, and I mean towards the end I will share this deck anyway with the team, so it'll be good for you to go back and look at that, because there's a lot of information already. Might not be very contextual to India per se, but still the principles are the same. So that's how we sort of structured. I'll quickly move to basically talk about uh, capital in general, right? I mean, if you today you're an entrepreneur starting off, there is significant sources of funding today for someone starting off, right? Compared to say a 15 years ago period where in India you had to bootstrap, or you had to basically go raise money from friends and family and try and build out something. Now there are multiple sources. So you can either bootstrap, fund it through revenues, you can go raise money from your immediate network, your family and friends. Now you have angels, you have angel networks, you have syndicates that operate in various angel network platforms like the angel lists of the world. You also have accelerators. And so the sources of capital actually are quite diverse. It's still not there yet compared to what it is in say mature markets, but it's still diverse compared to what it was say 10 15 years ago. And the so to that extent, entrepreneurs today it's much more easier for entrepreneurs to go back and raise capital, right? Along with this, along as we go on this journey and on this continuum and move along the chain, we also have venture funds. And again, venture funds largely you can classify them into seed stage funds, growth stage funds, and then obviously you have strategics as well. So strategics could be either corporate venture capital, could be the companies themselves looking to invest in interesting ideas. So while there are gamut of funding options available, right? What is important to understand is that across the spectrum, the motivations for each kind of capital is slightly different, right? The motivation is different, the return expectations are different, and also sophistication of the investor is different. So I think that's an important message, and that's an important thing to keep in mind for entrepreneurs when they're actually looking to raise. So if you're raising from friends and family, obviously the return expectations, the motivation for friends and family to basically invest will be very different from if you're raising from a venture fund. So to that extent, you should recognize that, understand that, and if required, tailor your pitch accordingly, right? So that's the important message. I'll quickly just couple of differences that I'll talk about. See, friends and family, and like in the industry, it says three Fs: friends, family, and fools. Right? Typically, come in very early. They're betting on you, betting on your credibility to build something. Largely, they're looking at capital preservation, maybe some amount of appreciation. Right? It's not they're not going to be measuring you on IRR. They're not going to be measuring you on how much multiples you gave them, right? So that typically is the motivation. uh, Angels, again, angels largely, typically angels, what we have seen is a lot of people, while they have a clear motive of increasing capital. A lot of them also have this thing of giving back to the community, helping early entrepreneurs early stage and stuff like that. Similarly, networks have a slightly different motivation. Syndicates again have a slightly different motivation. So as you go along this chain, like I mentioned, return expectations vary, motivations vary, right? And sophistication also varies. So this is an important aspect to keep in mind. So it's also an important aspect to keep in mind, and also go back and unearth what the motivations are. So that's basically first. I'm just moving to the next one. Just specifically, I want to focus this session more on VC because that's what I do, and give you a flavor of what typically drives VC, right? So just the background of what is a VC firm. A VC firm is a set of professionals, set of managers who actually go raise money from various sources. I mean, it could be HNIs, could be family offices, could be pension funds, could be corporates, could be any other sources, and go back to these guys and raise money and set the expectation they're going to deliver outsized returns, right? So what I mean by outsized return is, I mean, a typical venture capitalist would go to a family office and say, you know what, you're normally generating, say, a 15% IRR through its multiple investments. Now, do you want to go back and allocate a small portion of your capital, say 5% of your capital, for high risk, high return kind of investments? And therefore, the target IRR there is basically not your 15% IRR over 5-6 years, but 30% IRR. So that's the typical kind of money that VCs raise, and the whole expectation is that it will generate 30% return. So the asset class is slightly different from a normal investment asset class, right? I mean, you have fixed deposits, you have mutual funds, you have the family offices or the mature investors have access to all of these. What they're trying to get by a VC asset class, an investment in a VC fund, is a high risk but a very high return asset class. So I'll just give you an example. If you take an example of a fund size which is say 100 crores, right? In a 5-year period, a typical investor into a VC fund will expect close to around say 400 crores to be returned. This is just based on a target IRR and a period. So for the VC fund manager, he has to be able to ensure that a 100 crore fund size is able to basically give him returns of 400 crores within the fund period. And while it seems 4x, right, it is still, I mean, if you just compare that with normal market returns, it's significantly higher than what normal investments in the market will give. So that's the nature of the basic of the financial instrument VC, right? uh, I'll pause here for a minute. Any questions? Cool. So then basically, because the VC is basically looking at outsized returns, then basically what he's trying to do is, the whole model is that he is going to be betting uh, on a few outsized returns in his portfolio. So you would have probably heard this term. The VC model is built for few outsized returns, right? It's a oft quoted sentence. So I'll just sort of explain that to you what it means. Just take the prior example of a 100 crore fund, right? Assume that in the 100 crore fund, you're basically doing investments, 20 investments, each of 5 crores each. And I mean, for the sake of mathematics, I've simplified it. Assume that these 5 crores will get you in equity of 10%, right, together. And the valuation that which this fund does the investment is say 50 crores. Now, I've just taken this basic fund per portfolio strategy, or whatever you call it, and broken it down into two scenarios: a scenario one and a scenario two. A scenario one where you have average returns, and a scenario average returns but well spread out returns among the portfolio, and a scenario two where you have multiple companies failing but then two outsized returns. So just to give you an example, just to go back and explain the numbers, right? Take a scenario where you have, out of the 20 investments, 10 of them generate 4x, 10 of them generate 3x on the capital. If you just add up the math, you see that middling returns, even across the entire portfolio for the VC, doesn't actually cut it in terms of what his return should be. So you net basically 350 crores in this example, whereas your target based on the previous slide you would have needed at least 400 crores to go back and basically return to your investors. Whereas the second example, where in an investment of 20 companies, 18 are write-offs, right? But then one is a big bagger, one is a multi-bag, two are multi-baggers. One gives you a 50x return and one gives you 30x returns. With two companies or two portfolio companies, the VC fund is able to basically go make its target, right? It's able to hit that 400 crore mark. So this is the nature of the VC business. So I mean, and this is something that it's important for entrepreneurs to ingrain, because if you go back and pitch to a VC saying, you know what, in the next 3-4 years, 5 years, I'll be able to give you a 5x return. The VC in all probability is saying, yeah, nice, but I'm not, doesn't make it for me, doesn't cut it for me, right? So that's a very important aspect to remember. And typically the way VCs think also, if you just go back, typically historically what's been observed is it just the power law again applies here, right? 20% of your investments typically will drive more than 80% of your returns. So again, the important aspect to understand is they're okay to fail, they're okay for you to fail, and this thing, but not uh, they're okay for a company to fail, but they still want at least one or two companies in their portfolio to succeed and make it a mega success. So middling success typically doesn't cut it for them, right? So that's broadly the message of the slide. I hope this gives you a perspective on how the VC model works, right? Just going to the next one. So now that there's some understanding of how this works, it also means that it's got some implications for people trying to raise capital from a VC, right? So you know now for a fact that outsized returns actually are needed by your investor. So what does that mean? It means that he's going to ask you saying, are you working in a large addressable market? Because if you're working in a market that's not very large, very soon you're going to hit a ceiling and then you can't grow at a scorching pace further, right? So it has to be a large addressable market. uh, just take for example Flipkart, right? I mean, when the Flipkart acquisition happened, uh, there's still the penetration of ecom in a country like this was relatively minimal, and there's still a large headroom to grow. So that's typically what a VC will look at, because then there's the opportunity for the returns to be significantly higher, right? Then rapid scaling. This is another important aspect of VC requirements that a lot of promoters, a lot of founders tend to misjudge, right? You can grow at a 15% CAGR. You can grow at a 30% CAGR. You can grow at say a 6% CAGR profitably. Now, uh, uh, typically what a VC would like is basically want you to grow at a breakneck speed, right? That's because just uh, going by the example of what we had talked about earlier, if you have to achieve a valuations of say 2,500 crores in 5 years, I mean, you at least have to have be able to go to a revenue size of 250 to 400 to 500 crores in that period, right? So from 0 to 250 crores in a period of 4 to 5 years, basically I'm just taking a multiple of say anywhere between a 5 to 10x of revenue. To grow from a 250 crores to a 500 crores revenue in a period of 4 to 5 years is not easy. No? So the ability of the team, the desire of the team to basically scale very fast is something that VCs would expect, right? The third and the most difficult point, I guess, is VCs. I mean, they typically judge whether is the timing right for this, right? For example, uh, the Flipkart succeeded in say 2000 when they started in 2008 9 and started building out, whereas Fabmall, for example, and Rediff and all the other shopping guys who had started much earlier, basically we're not able to go back and create that much of impact. So the biggest question in VC's heads when they're investing is the timing right, right? Because largely they want to go back and ride the wave of the market opening up, right? And so that's an important aspect for founders to think about, right? And largely it's the not easily replicable, the moat question always exists, because uh, for founders basically need to go back and convince that their model is not very easy to do replicate, because VC, last thing a VC wants to do is invest in a company and then realize that the business is so easily replicable. There are 15 others mushrooming everywhere else and beating this guy, beating the existing company on costs or on whatever parameters. So again, mode becomes an important aspect to go back and think about. But the most important thing for founders, basically in all of this, apart from the largely some of these are external factors, right? The market that you're working in, the timing, right, are external factors. But the most important aspect that they can go back and think about is what's their mindset, what's their ambition, right? Are promoters, and this is something that they need to go back and introspect and then decide, because uh, are you in this business to basically go back, create uh, a institution that runs for say 15, 20 years, take care of employees, take care of customers, might not be growing at a scorching pace, but run it profitably and this thing? Or are you basically in this to basically go build out something very fast that at some point of time might be people might be interested in buying you out, or larger guys will come in and take it from there. So it's an important aspect to go back and think about and see whether what's the ambition for promoters, right? So given what VC wants, what VC typically needs are, these are the important questions for founders, and these are the important aspects for founders to consider. That's the way I'll put it. Right. Sorry, just give me a second. Yeah. So then let's go back to, now that we heard typically how VC works, we also heard what expectations or what, I mean, how VC basically drives expectations on the business. The key question for promoters, I think, to ask themselves is VC the right thing for my business, right? And it's an important question. Uh, I think it's important for you to go back and have that thought, have that discussion, maybe speak to a few people, because if you go down the wrong path, it's going to be difficult for both you as well as the investor. So it's a couple of resources that I've shared, basically walks you through how you do it and what kind of companies should actually raise VC, what companies shouldn't. But the long and short of that is, if you're looking at an opportunity that basically you can go back and create say 100 million, 50 million, or say in this 300, 400 crore business rapidly, and it's a virgin market that you're trying to capture, and you can go back and create that rapidly, and the opportunity cost of not doing that will mean that someone else will come in and beat you to it. Then maybe it makes sense to go back and raise VC. But if you're looking at creating a decent sized business which is profitable, which gives you uh, decent returns year on year, stuff like that, then VC maybe might not be the right for you, right? So this is important aspects for people to consider. Another aspect that I talk about, which is point number 3, is again, all VCs are not the same, right? It's important to understand what kind of VC firm you're working with, because the just going with the same logic, a smaller fund might not basically want a big a mega return compared to a larger fund. Because I mean, if you just the math on that is, if you want to go back and a 3x of a say 100 crore fund, or a 4x of 100 crore fund is basically 400 crores. Similarly, of a 4x of a 700 crore fund is 2,800 crores. So if you have by chance a 700 crore fund in your cap table, they're going to try and drive you to a much bigger outcome, and you have to be cognizant of that. You have to be cognizant of what do you want to do, whether you want to go do that or whether you want to go back and work with a smaller fund maybe, right? So that's important to understand. Some of these are excellent blogs of guys who've been in the ecosystem for quite some time. They provide a very nuanced view. I'll encourage you to go back and read through these. But largely, that's important criteria, I guess, for entrepreneurs to go back and decide whether VC is the right thing for them. So I'll pause here. Largely, this is in some ways a logical conclusion. We sort of try to cover what VC is, how does it work, what does it mean for entrepreneurs, and also some view on how it is, what should people think about, and is basically how do they consider whether VC is right for them. I just see that Sampath is raised a hand, so maybe just Sampath, if you have a question.
Yeah, thank you for detailing on the VC concept.
Yeah.
VC generally looks only on technology companies, right? They don't fund traditional companies.
Yeah, so so typically VCs don't have a problem with funding traditional companies, but they look at it from the lens of saying, can it scale rapidly? Now, by definition, what we're saying is the traditional company tends to be uh, not something that can scale very rapidly because it's in a mature market, its business is mature. It's a steady growth kind of business. So in that case, VCs might not tend to look at it. It just
So only
functions.
hyper growth
Yeah.
companies which has got an hyper growth opportunities are the only candidates.
Yeah, typically yes. Yeah, typically yes.
Okay, thank you. Thank you.
Yeah, sorry, Teja. Yeah, hi Teja.
Yeah, I had a quick question. Am I audible?
Yeah, Teja, go ahead.
Yeah, thank you. So as far as VCs are concerned and early stage investing is concerned, like, as seed fund, pre-seed and all of that. So there are other options probably available where there are angels and there are, non-institutional investors also, HNIs, like you said. Is there any suggestion that you would give at the timeline of where you could, if it is, all of the other conditions are satisfied, like it is hyper growth and, the segment and all that works out. Are there any recommendations that you would give as to where do you get, which is a preferable timeline to get a VC into your this thing? Is it when you're about to start your growth phase, or it is better to have them right from the front so that the growth mindset also comes into your company or anything? That's
okay. So largely, if I can paraphrase, you're saying what's the best time to go back and raise VC capital, right? What's the best time to go back and raise external capital? So I would say this: it is a function of what market you are in and what do you stand to lose if you don't get to that hyper growth kind of phase. So it's a question of saying, can you do this next year and still basically be number one in the market and number two in the market, or will that be too late, right? That's the question that I think entrepreneurs have to answer. And if you think that basically it'll be too late if you delay this significantly, then I think you should go back and raise capital. Now, whom to raise it from, what kind of investor that you need to look at is a function of what stage you are in terms of your product, your startup journey. There is no right or wrong answer to this, right? You can go the traditional route of raising money through friends and families, go to angels, then go to say seed funds or VC funds and raise. You could directly go to seed funds, VC funds and raise. There is no one right way to do it. It's a function of what stage you are in, what kind of help do you need at that stage, and then go from there. Does that answer your question?
He's on mute now. So there are a few other questions that has come up in the chat box.
Yeah, sure. Let me look. I'm just looking. Yeah, so I'm just going through the questions. VC funding from Kate, everyone. VC funding is available only for novel, innovative products or services applicable for traditional startup. I think we sort of answered that. VC consider early stage funding for startups, pre-seed, seed, etc. Yeah, so there's a question from John which asks us, does VC consider early stage funding for startups? Do VCs in some ways play at the pre-seed, seed stage as well? The answer is yes. There are specific funds which focus only on seed stage, pre-seed stage. We are one such fund. Arali Ventures one such fund. There are other funds as well. Some of them have a sectoral focus. Some of them are broad-based. There's some funds who focus more on stage and are okay to multiple sectors. There are some larger funds also who have a special program for early stage startups. So the short answer to John is, do VCs consider investing early stage? Yes, they do. I think it's a question of you finding them and going from there, right? How would you explain the funding of Ola and Uber? They both started in a similar manner. VC funding and all. Sorry. How do you explain the funding of Uber and Ola? They both started off in a similar manner. Okay. I'm not sure exactly what the question is all about, but if I can understand, maybe the way, if I can basically interpret it, is like saying, how come you have Ola and Uber, which are similar businesses, getting funded? If that's the question, my answer to that is like, while Ola and Uber are similar businesses, the market opportunity is so huge in cab hailing that there is potential for you to for you to have, say, 3 or 4 large businesses across the world. Even India, for example, there is potential for you to have, say, 2 large businesses built on cab hailing alone, and that's why you have these kind of companies that are funded. How do you reach out to smaller funds? Uh, uh, I mean, there are specific smaller funds. There are places where you can get information on smaller funds. I think Arun from Thai Chennai itself, he runs Venture Intelligence, which gives you information of all the different funds that are listed and investing in India. So there are platforms available. You just have to go out and seek out information through these platforms. Let me just go back. Is there a notion that before going to a VC, a startup should have been funded by an angel or avail seed funding? No, I mean that's there's no hard and fast rule about a startup having to have funded before, right? There's a question on angel investor and a venture capitalist. Uh, Angel investor, we sort of covered that, right? An angel investor is more investing his own money, and so to that extent, it might not be a very formulaic approach in terms of saying, okay, I need to make, say, 30% IRR or 30% IRR on a particular investment. Whereas a VC or a venture capitalist is a professional doing this on behalf of others. He's raised money and he's investing. So to that extent, he's probably more structured in terms of his return expectations, and therefore that drives the strategy largely. I mean, that's probably some. They are angels who actually are very structured as well, sometimes more structured than VCs. But I'm just talking about the norm here and not the exceptions, right? So that's the response to that. I'll maybe just take a quick time check. 30 seconds. What I'll do is some of these questions, while there are a lot of questions, I also have half of the presentation on what should you do when you're raising capital. Maybe some of this will get covered there. If they're not covered there, we'll come back to these questions, right? If that's okay. So I'll just move on. Right, so raising venture capital, we talked about how venture capital works and therefore what it means for promoters. Now I'll just talk about a standard way of how do you go about raising venture capital, right? And I've just put together a set of slides in terms of broken it down into various stages, and I'll walk you through each one of these stages. But the key aspects to remember are basically saying, think of fundraise. I think I basically speak to entrepreneurs all the time. Is saying, okay, they go back and say, for the next 2 months I will fundraise, right? And then I'll go back and do my business. That to me is is a slightly wrong notion to have. What entrepreneurs need to think of fundraise as an ongoing activity, because it doesn't normally get done in 2 months. And also, if you're going to be multiple rounds, you are going to be pitching this to various investors at various levels, right? So think of fundraise mentally as an ongoing activity, right? Budget for the time and effort. It is going to suck up a significant amount of your bandwidth, so be prepared for that, right? Ideally, what we've seen is when you have large 2-3 founders, one of them takes on the mantle and drives this process, whereas others focus on the business. So to that extent, you don't have a significant impact on the business. But that's important to go back and get this thing straight, saying I will not. It is not a 2-month activity that you do once every 2 years, right? It's something that you basically think of it as ongoing, right? The other thing that we see normally people doing a lot is basically not putting together a structured process for fundraise, right? And believe me, putting together a structured process, I'll come to what kind of structure that you need to have on the process, right? What kind of structure will help. Believe me, the structure actually helps significantly. So there's nothing that beats a structured process for fundraise, right? And the last thing is, I mean, in a lot of ways, I think you have to be truthful and honest to yourself, right? It is not a judgment on you as a business. It's not a judgment on you as a promoter or as a business if you're not able to raise money, right? If you go in to a fundraise with being open and being truthful, you will probably gain a lot more feedback, a lot more. You'll get a lot more from that process, right? Which will probably help you anyway in your business. So that's an important aspect to go back and think. I mean, ultimately you're going to be driving the business. Someone else is opining on that. Uh, but if you're open about it, and if you're basically honest to yourselves, maybe you'll get ideas on how to shape your business, how to basically change, and then go from there. So these are broad principles. I'll go to each one of the steps, right? Largely each one of the steps, I'm not getting into specifics of how you do it. I'll talk to you about are what are we observed typically, right? And what you should probably try and avoid doing. So the first thing is basically when you're looking at fundraise, draw up a plan. And draw up a plan, typically what we see is people get a chartered accountant involved and do a complicated 15 tabs Excel. And sometimes most times it's an overkill, right? What typically a VC looking at is saying, uh, how much are you raising to do what, right? So your plan typically, if you're going to a VC, is saying, okay, this is the kind of money I need, and this is the kind of milestones I want to hit. That's all you need in the plan, right? And obviously you need the detail to substantiate it. So where I would basically do it easily is just cite milestones for the business. What are you going to achieve in the next, say, 18 months to 24 months? To do that, what do you need in terms of resources? So the simple principle basically is saying what cash in, what's the cash out, and what milestones are you going to achieve. As long as you can keep it that way, I think you've done your job when it comes to VC fundraise. And the other important aspect, right? I mean, sometimes we get into these discussions with entrepreneurs and we ask them on specifically on the plan, ask them some numbers, and they say, oh, you know what? I don't have a great idea of this. I have to get back to my CA. Just give me some time. And so that's a big red flag to someone who's investing. He says you should have a grasp on numbers. We are not asking you for uh, uh, significant. It's your plan. We are asking you what is the plan translated to in terms of numbers. So it's a red flag to VC when the entrepreneur says, you know what, I don't understand this plan. I'll get back to you. Right. The other thing that a lot of times we see is there's a tendency for some entrepreneurs to basically go back and start spending lavishly on once they raise funding in the plan itself, right? A VC looking at saying, I mean, they're more than happy to fund what's essential for the business, but typically also appreciate frugality, right? I mean, you understand that it needs to be you need to go back and spend something to actually go back and achieve milestones. But if it's not going to be overall in the helping you in achieving your objectives of achieving some traction in the market, then it's not going to be it's going to be a red flag for the VC. So this is something that you need to go back and think about, right? Red flags, large red flags. I've talked about inflated costs, right? People start uh, paying themselves. Sometimes promoter starts paying themselves higher than normal salaries, which is a red flag to the investor, because the investor is now thinking, you know what, there is not enough desire, there not enough ambition, or at least the entrepreneur not showing that. Lots of times we see very unrealistic revenue targets, right? I mean, on a plan, and that to me is basically going fully on the other extreme, saying, you know what, I'm 50 lakhs today, next year I'm going to be say 20 crores, and the year after that I'm going to be 100 crores, right? It doesn't work like that. I mean, so you also have to be, some amount of realism has to be there in terms of how will you get to that, right? And I already talked about, right? So let me check with my finance, let me check with my CA. You're not on top of the numbers. It's always a red flag for VC investors. The other thing that we sometimes we see is basically saying there is raising a lot of money, but some of the money is going to early stage investors or earlier investors. That to me, that always sometimes, at least for early stage investors like us, is a red flag, because uh, there's a feeling that earlier investors are exiting, and therefore they know more about this business than I, and there's a reason why they're exiting. So that sometimes is not a good sign for incoming investors. So that's something for people to be careful about, right? Just go back. um, the next slide, research. And I think this is an important aspect of fundraising that a lot of people ignore. Uh, and obviously, uh, if you look at someone who's raising money, if you just compare this with someone who's raising money, a startup that's raising money in the US, right? This is something that they typically will do well because of the culture that they're in, right? I mean, they'll go back, look at a fund, they'll go back and look at what investments it's done, they'll go back and identify the partners, do all of that. Whereas in India, we don't tend to do that. We tend to say, we tend to just spend lesser and lesser time on it. So it's important to do this, because uh, your chance, the VC world, while it is still small in India, has got a lot of diversity. He's got, each VC has its own themes, his own stage preferences, his own investment size preferences, right? So it's important for you to go back and understand all of that before you start uh, going and randomly reaching out to VCs and asking the question. So, for example, you're looking to raise, say, a 15 crore kind of fundraise. There is no point filling up your target list with guys who typically do a 3 crore, 2 crore check, because even if a 3 crore guy comes on board, right, you still have a gap of, say, remaining 12 crores to fill, and you have to go and do this whole process again with the largest investor. Similarly, there is no point going and hitting typically guys who do $1 million checks when you're looking to raise, say, 100K, 150K for doing your first product beta launch, right? So that's important for you to go back and discover. Secondly, a lot of VC firms, at least the bigger ones, have partners who are focused on different themes. So if you're a fintech, there is no point going and pitching to a partner in a large VC firm who largely looks at, say, robotics or manufacturing 101. If he's in a good mood, if he likes you, maybe he'll put it on to someone else. But chances are that that ball will get dropped somewhere in the way, and then you will lose that one this thing. So it's important for you to understand who those guys are, and reach out to the right people, right? Then it's also important to go back and do some research on what will someone like a big investor bring to me. What will they bring? There is capital. There is capital plus. Say, for example, you're going to basically invest. You're a SaaS company. You want to go and build out a business, and that is largely focused on clients abroad. You would probably go to an Axel, you will probably go to a Sequoia, because they have done this before. They sort of have this model that's in some ways perfected. They have the network, they have the connections. So you go to them when you're looking to raise a $3 million, $4 million check. Will you go to them early when you're raising a 150K? Might not be, right? And again, there you'll go to the specific partners who is looking at enterprise SaaS. You might not go to the guy who's looking at fintech. So this is important for you to go back and do this research. Now, how do you do this? There is some data available. There are subscriptions available to various websites that you can go back and do. But again, if you're deciding to do a structured process, I would emphasize this a lot more, because someone comes to me and says, hey, you know what, I know that you invested in this. We are doing this. I know this is a space that you track. This is what we are doing. And we could also be in some ways helpful to your portfolio companies, blah, blah, blah. And suddenly my interest is peaking. I mean, I can totally go back and give him much more time than normally what I would, right? So that's very important for people to do, right? Are we still on? Yeah, great. Structure, again, we talked about putting together a process. That's what I mean by structure here. I think what's important to go back and get into people's heads is like fundraise is just as much a sales process as your typical sales process of selling to your customers is. So whatever you do to set up a sales process, right? Set up a CRM equivalent, set up a database, set up some kind of process by which you go back and read out, you go back and circle in. That is something that you need to do here as well, because otherwise it tends to be very haphazard and it doesn't help you, right? Secondly, what typically VCs would want is some time to go back and understand what you're doing, and much before a fundraise, they would want to get to know the entrepreneur much before the actual fundraise event is happening. So typically we would encourage you to come back, have a chat, talk about what you're doing, pick VC's brains, think about whether they find it interesting or not, and build some kind of a relationship before the formal fundraise process. Because if you're going to throw a deck and say, okay, you know what, this is what I'm doing, decide in the next 2 to 3 weeks, right? Even if there's a bit of a hesitancy, that then you're basically the VC is going to tend to say no for the moment. So it's important. I see the Indian ecosystem very few entrepreneurs do this, but it's an important aspect to go back and consider, right? And again, leverage networks. You typically, as a VC, I look at a deal more closely when it comes from someone in my network who can actually vouch for either the promoter or the idea, saying, you know what, these people are doing something interesting. Just writing to an email that's there on the VC deck it's not that we will not look at it, but typically the larger firms get close to say 100, 200 emails a day. I mean, we get close to say 40, 50 emails a day. So sometimes things will get dropped. So it's always better to get a warm introduction and go back and have a chat with the VC. So leverage networks, it's important. Again, I don't see people collaborating to the extent that they can in India, but it's important to do that, right? And largely, I want to leave this last message saying it's okay to basically hear a no, right? Lots of times I have this thing where people actually send me a deck, we do a discussion, and then that's it. That's the end. That's the end of engagement. I'm in some ways it's okay for me if it's a deal that I was not comfortable in any way. I would much rather not have the promoter come back and ask me, hey, you know what are you thinking about this, right? Because it's just human nature to go back and escape out of a situation where I don't want to say no. But if I were a promoter, I'd go back and say, you know what, we had this discussion. What are your thoughts? Give me your feedback. That feedback is important because it will probably help shape some of your thinking, some of what you need to do further. So it's okay to say no. I mean, I think everyone who's going to fundraise will hear no's. There is no two ways about it. I mean, we raise funds every 3 years for the VC fund. And typically we get to hear a lot of no's, right? But that doesn't matter. I think you should just go back and say, you know what, doesn't matter. I'd still treat it as feedback. And so that's important for you to go back and inculcate. Make it a point, push a VC to actually give you some feedback. It might be a no, but that's okay, but ask them to give you some feedback, right? We just have last two more slides. One is on the pitch and the other one is on this thing. So when you're pitching, right, so a couple of these are some of the points that we normally come across. A lot of people come to us and say they pitch the tech and the tech only. To me, I'm investing in a business. I'm investing in a business. I'm not investing purely in the technology, right? So when you're going back and making the pitch to an investor, talk about the tech. The tech is important, but talk about the business as well, right? And say how it's going to return money to the investors. I mean, in some ways, great tech doesn't give you revenues and doesn't give you dollars. So just talk about the tech, but important aspect to cover is from the business side as well. That's something that a lot of people miss. It's important for people to entrepreneurs to remember, right? Uh, Typically, we are going to invest in businesses that have momentum. So if you
Hello, Mr. Arun. Hello, sir. The thing is, there's a small problem with your connection. You're not audible right now. So what did it say? That. So sorry for the inconvenience caused. Mr. Arun is facing some network issue, so he'll be joining us again in about 2 minutes. Really sorry for the inconvenience. Thank you. Yes, sir, Mr. Arun.
Hello.
Yes, sir, I can hear you.
Yeah, I'm sorry. I had to log in from a different machine. I log in from my phone, but for some reason it's not connecting to the laptop. So, can you hear me?
Yes, sir. Yes, sir. Understood. So, will you be? How will you be sharing the presentation? Do we?
Yeah. So let me. They just last two slides. I'll mail it to you.
Done.
Just give me a second. Are we okay to stretch it by another 5-10 minutes?
No problem, sir. We can do that.
I'm just mailing it to you as we speak. Saurav, I just shared it with you.
1 minute, sir.
Yeah, just last two slides. I'll also see on my phone. Share screen. But let me know when you have received it.
Sir, I haven't received it as of now. Reloading.
Okay. Let me see if I can share it on here. I'm Can you see my screen?
Sir, I'm not able to see your screen.
Is the screen being shared?
Yes, sir. Now I can see.
You can see it, right?
Yes. Yes.
Yeah. So apologies for everyone, but I'll just continue. I just have last two slides where I want to talk about the pitch and the negotiation process. So, like, I don't know where I got cut off, but I'll quickly go through some of the points. So, one of the important points was emphasize the business, not just focus on technology. right? Talk about traction. It's important even at an early stage to talk about measures of traction, right? And lots of times we we get promoters to talk not specific about what problem they're trying to solve, and for which person in the organization, what's the kind of benefit he'll get, and does he have the ability or the money to pay, right? So that's very important. Just talk about specific problems, and who's the person, who's the user, who's the buyer, what kind of problems it solves for them. uh, Similarly, why is now the right time, right? So that's a very important question. So why is your idea going to succeed now compared to say maybe say 2 years later, or 2 years earlier, right? So that's important aspect for you to cover. uh, another thing that we find is people don't talk about competition enough. I mean, in their heads, maybe it's not important, but it's always for us. It's a red flag when people are saying, "Okay, these guys." When a entrepreneur is not talking about competition, you can acknowledge them. You can say that they're doing this, we're doing something different, and all of that. But not talking about that is a definite red flag, right? And couple of other points sound self-explanatory. Demystify. Lots of times, VCs are not experts in multiple areas, right? So it's important for you to demystify what you're doing, give them an understanding of the lay of the land, de-jargonize, and get them to understand the business first, right? So that's very important. Lots of times we get thrown jargon, and after some time, if you're not able to get it, the easiest reaction for a VC is to say, you know what, it doesn't make sense. Uh, so the most important aspect again while pitching is it is important for you to have a conversation with the VC, right? It is not, it is selling, all right, but it doesn't mean that you have to speak all the time, and you're not asking them for views, you're not asking them for insights, you're not asking them for what they're thinking. Uh, and Lots of times VCs evaluate. I mean, no one in our world, especially when you're doing early stage investing, uh, neither the investor nor the promoter sometimes knows what's going to work. So largely, VC starts evaluating promoters on how flexible they are to go back and change, how easily, how flexible they are to go back and adapt, and that's very important to actually convey in a conversation. Uh, and it is perfectly okay to say I don't know, right? It's perfectly okay to say I don't know, especially especially when you're pitching to early stage VCs, or you're pitching earlier on in your startup life cycle. It's perfectly okay to say I don't know. We don't expect people to have all the answers. I'd rather have a promoter saying, you know what, I don't know, I'll figure this out, than come back and make up something which is blatantly false. So it's a very important aspect to remember. And lastly, this again, some of these points are things that we see with a lot of entrepreneurs. A lot of entrepreneurs tend to be very valuation centric, right? Saying, okay, you know what, I want to go back and raise my money at a minimum of say 4 million valuation or a 3 million valuation, right? My reaction to that is typically in early stage valuation, it's a balancing figure between how much equity the incoming investor wants to hold in a company and how much money is needed for the business to take it to the next milestone. So I'll just give you an example and walk you through an example, right? You are a fintech company. You go to an early stage investor. The early stage investor basically uh, thinks that you can do with a 3 crore amount to go back and build out a POC and stuff like that. And he typically, when an early stage investor comes in, he wants to have at least a 12% to 15% of your business, right? So that roughly translates into say 15% roughly translates into a 20 crore valuation for you. But the same company, if it goes to a larger VC fund, and the larger VC fund typically says, you know what, I like this space, it's interesting, we want to go back and participate in this early, and I'm willing to cut a $1.5 $1.5 million check for the same business at the same stage. The latest stage VC fund will come back and say, you know what, I'm coming in early, but I typically want to have a 25 to 30% stake. It doesn't mean that the valuation of the company, I mean, in reality, on paper, the valuation is moved from a 20 crores to say maybe a 40 crores. But that just balancing figure. It's a figure. It's a this thing between how much money is coming in and how much equity uh, the incoming investor wants to hold. I sometimes when entrepreneurs are very fussed about valuation at this stage, it just gives VC funds the wrong signal, right? So that's very important for you to go back and think about. And lots of times, what I see entrepreneurs do is once the valuation and the fundraise has been decided, they don't pay enough attention to other terms. Trust me, the valuation is just one small aspect of it. The other terms actually can make or break a promoter's return from a company. So it's very important to understand what those terms are, and very important to go back and have a position on each one of those. Right? This is something that I would encourage all of you to do. Just get people who have been through this process to advise you, right? Over say one and a half 2 hours, you can actually get a very good understanding of what are the pitfalls, what you should do, what you shouldn't do. And it's best that it comes from someone who has gone through this process before, because they will very easily understand uh, where you could go wrong, and walk you through that. And couple of other things again, don't penny pinch on either legal advice or 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 people who will help you with compliance and stuff, right? uh, it's you'd rather, in my view, rather spend that money getting a good lawyer, pay him say 50,000 rupees more, but get good legal advice. And also just remember, if you leave to legal firms to go debate it on the VC side as well as from the startup side, they will do this process. Even if you ask them to do it over 3 months, they will do it over 3 months. So it's important for you to go back and emphasize to the legal teams that you want a decision fast. And in the broad principles you give them, but they have to actually push them to go back and move to get to a position fast, right? Similarly with compliance, get good guys who help you with your compliance on your business. I have personally seen multiple deals that both the parties wanted to do but fell through because on the compliance front the startup didn't measure up. So it's very very important. I mean, it's a difficult thing to do, to spend more in the hope of getting VC money, but this is in some ways, just think of this as saying you're adding value to your own business by improving your compliance posture. So to that extent, I think it's just not uh, you're not doing it just for the VC investment. You're doing it because it improves the value of your own business. So think of that. Get good advisors. There are lots of people who will come and offer you services at rock bottom prices, but sometimes at rock bottom prices you only get not very good advice. So that's something for you to go back and think about. And lastly, right, uh, till the money hits the bank, the deal is not done. Remember that, right? There's so many cases that everything is done, but there's something that happens and the deal slips through. So you have to be on your guard till the moment the money hits the bank. Only then the deal is done. So from a getting a term sheet to getting through a DD to all of that are just steps in the process. The actual deal is only done when the money hits the bank. So it's an important aspect to remember. Lots of times I've seen entrepreneurs, rightly wrongly, go through a euphoria of basically say having raised money and then go through another big down depression when actually something happens, the money doesn't hit the bank. So it's important to recognize these aspects and be prepared for it. So largely that's all I had, right? From a fundraise perspective, in terms of broadly what we have seen and what entrepreneurs should think about. There's a last slide where I put in some links, which are some very good resources, largely with uh, uh, focused on the US ecosystem. But they're very good reads anyway. I think all of you who are actually considering raising money should go back and read. Even those who are ambivalent, who are not sure whether they should raise money, should read some of those, which will give you a perspective of what you should be doing. So that's all I had. Happy to basically pause here, take questions right now. Maybe we can spend some time answering questions and then we can get into the mentoring session. That's okay?
Yes, sir.
Great. I'll stop the screen sharing now. Yeah, I see a hand. Sampath, and I see 11 questions as well. So can we go to?
So do you want me to stop your slide share, sir?
Yeah. Can you please stop that? I'm doing this over phone.
Yeah.
So I'm not very easy for me to do. So can you just stop that?
Yeah.
Mr. Arun.
Yeah.
I had even raised this question in the chat.
Yeah.
With the technology changing very fast, estimating a moat for a longer term is a challenge. So, how can a founder can give guarantee that the competitive advantage for profitability, maintaining the market share will stay for long, given the challenges in the rate at which changes are happening?
Right. Yeah. So it's a good question, right? So typically, what we would think is that the moat also will keep evolving, right? I want people to think about what's their moat now for the next 18 to 24 months, rather than a moat that will be perennial. And the question is, therefore, in the 18 to 24 months, what can you do that will, in some ways, further the moat? That could be a series of customers, that could be series of people in the ecosystem who support your product, who are adopting your product, could be users, could be multiple aspects. So the moat, like I said, is not constant. It's again something that we keep
Evolving. So yeah, 24 months outlook on where the market is heading and how well we can serve those markets is adequate enough to impress VC, is it?
Yeah, to a large extent, yes. I mean, so as long as there should be some view on, even after 24 months, there are some visible opportunities to go build out a moat, right? It is not as if in the next 24 months you're going to be in a market that's totally commoditized and it'll be a free for all. Then it becomes difficult. But if you're thinking at that point of time, you will move into some other areas and you could develop some other moats, then yes, definitely. I mean, we also don't foresee a moat being effective over a longer period. You have to keep building on it.
Okay. Thank you.
Yeah. Next. I'm sorry, I'm not able to clearly look at the chat because I'm suddenly moved to my phone. Let me go back and look at the questions if there are anyone.
Hello.
Yeah. Hello. Yeah. Go ahead.
Yeah. Hello, sir. Thank you so much for the talk. This is Teja again. One quick follow-up question I had was generally when you're talking to a VC and pitching, especially in the Indian ecosystem sense, there is a general idea that you need to show a working model of some other country where this has worked. Like somebody mentioned, Ola, Uber. Like Ola fund, initially would have fundraised showing Uber as the example. Flipkart would have shown, Amazon and so on and so forth. Correct. So a lot of VC funds want to see that kind of a working model to just to be sure of that 100x, 30 to 50x return that you were talking about. So in certain industries like what I am working on, it is a very India centric problem. So which caters to local retailers and things like that. So in that sense, when you're approaching a VC, what would be a good way of the numbers right now? We have like 20 customers and all of that. But what would be a good way to show that promise of a 50x return if there is no a unicorn for that matter, which exists internationally, which has done and succeeded in the same manner?
Okay, so good question, Teja. I'll just tell you why VCs look at that, right?
Right.
And also give you the context in which it should be used and the context in which it doesn't make sense. Why VCs look at that is, if you look at evolution of technology per se, purely technology, right? And adoption of technology. Sometimes mature markets are ahead of uh,
Right.
adoption compared to a market like India.
Correct. Correct.
Right? So look at SaaS adoption, for example. Look at AI adoption, for example. Right?
Yeah.
So when it comes to products or services or offerings like that, we would look to see whether, and even consumer behavior for that matter, right? Largely, trends start there, and then they basically percolate down here. So when it comes to business like that, obviously VCs look at how was things evolved there, and therefore can you go back and create something here. So that's something that you need to keep in mind. But having said that, if you look at fintech, for example, mature market VCs actually look to places like India to see how fintech is evolved. That's because as a ecosystem, we are far more evolved compared to what is the ecosystem there.
Right.
So I would say you understand the ecosystem and then make a comparison of how the ecosystem here is compared to where it is. You find out which is more, in some ways, ahead compared to the other, and then do a comparison. If in your case, like you said, India is probably unique in terms of its problems, it's something that something for you to upfront go back and mention, saying, you know what, we cannot be compared to anything else in any other country, because what we are trying to solve is a unique set of problems, and these are the problems. If you are able to go and build the cat right up front, then I don't think you'll get that question anymore.
Right. Right. Okay. Thank you so much. Yeah.
Uh, I sort of lost when I switched from my laptop to my phone. I lost a set of questions which were there in the earlier chat. So, if some of the questions can be uh, thrown to me again, we can talk. I can sort of go through them, discuss them. I don't have the questions right now. It seems to have gone. So.
Sir, I think our time is also done. We have the other mentoring session to go to.
Yeah.
So I think let's stop taking questions for the time being. Probably, if there are any other questions, I can connect them offline to you.
Yeah, sure. You have my details. So just connect them offline, and I'm more than happy to have a chat outside of the session.
Done, done. I can do that, sir. So yeah. So on behalf of Titan, thank you so much, sir, for agreeing to be a part of today's session. I'm sure our members would have taken great value out of this session. So thank you again.
Yeah, sure.
So right now I'll be
Thanks
ending this. I'll be ending this chat.
Yeah.
And I'll be opening the other mentoring sessions.
Yeah, will do. No worries. I'll also join the other Zoom meeting.
Understood,
Thank you.
sir.
Thanks, everyone. Thank you.